Hello everyone and welcome back to these sessions on strategic financial management. Friends, in this class, in continuation of the topic derivatives, within which we are learning options strategies. In the previous class, we started the discussion about spread strategies. I told you there are four important spread strategies: bull spread, bear spread, butterfly and condor. In this class, we are going to learn a little detail about bull spread and bear spread. And here what we are going to do is, we are going to deal with situations where you will be understanding the application of these strategies. Now, not just from examination viewpoint, from real life understanding as well, these strategies are very, very important. So, how does a bull spread work? How does a bear spread work? I have already explained it to you. Just let me summarize it once again. You need to choose either call options or put options and then make a combination of holding a call and writing a call in such a way that both of these are exercisable at the same date, means the maturity date of the two options will be same, but the exercise price or the strike price of the two options will be different. So at one option you are becoming call holder, another option you are becoming call writer. Alternatively, you can create a combination of a long put and short put, means holding a put option against writing a put option. And again, the exercise date or the expiry or maturity date of the two options will be the same, but the exercise price will be different. Then it is a spread created using put option. Now, when will it be a bull spread and when it will be a bear spread? The idea is very simple. If your strategy formulated is resulting into an outcome where you are making profits when the price rise and when you are incurring losses, it is when the price is falling, it is clearly a bull spread. In a reverse scenario, it will be a bear spread. So, depending upon your sentiments, you can create either bull or bear spread. So, suppose you have tendency of or expectation of the price moving up, so you should create bull spread. Then you look into creating bull spread with call. Is that giving you a better outcome, or with put options it is giving you a better outcome? Compare and see which one suits better and accordingly adopt these strategies. So, when I am taking you to the calculative examples, very good examples, and here I am not picking examples from your institute study material. I am picking examples from my book because these are definitely better examples for you to understand not just the calculation part, but even the conceptual application, and most importantly how to design these strategies in reality. If you can keep that focus on, it will be something great. So let us not waste any moment. Let's directly get into the examples, getting started with question number 62 from our book, and let us read this question first. Consider the given information. Type of option is European call. Exercise price of option bought is 60. Exercise price of option sold is 70. Premium on option bought is rupees 9. Premium on option sold is rupees 4. You are required to draw the payoff table and to indicate profit or loss for different price ranges of the stock. Compute the break even wherever applicable. Draw the payoff graph and name the strategy. Now, first of all, you need to understand one thing very well. This is a scenario where you are talking about call options. First, make up your mind, when is a call option exercisable? When the market price is greater than the exercise price. So, market price less than the exercise price, or even market price being equal to exercise price, it will put the option into a lapse mode, means the option will not be exercised. Option will be exercised only when it is in the money. And when does a call option become in the money? A call option becomes in the money only when the market price is greater than the exercise price. So here the question did not give you any range of prices. but you have to rationally figure out how would you make a range of price where you will find every possible prices you have considered. So now the two exercise prices that are available in this example, if we focus on the lower exercise price, which we will call as E1, the higher exercise price will be called as E2. See, don't get ever confused with what is informed first and what is informed later, because graphically when you are putting x-axis, on the x-axis when you start plotting all the exercise prices, it is 60 that will come first and then only 70 will come. So they may inform you 70 on top and then 60 at lower line, but you don't go with the sequence of their information. You just consider the lower price will always be considered as the first exercise price or E1, the higher price will be the E2. At one particular price you have become a call option holder, at another particular price you have become a call option writer. So it's basically combination of long call and short call. Now how do you make up that table, the payoff table? That is most important. So if I look into all possible price ranges, what comes in my mind will be 5 different ranges. Number 1, market price less than rupees 60. Number 2, market price equal to rupees 60. Number 3, market price which is greater than 60 but less than 70. Then market price which is equal to 70, and the last one will be market price greater than 70. If I plot this entire table, 5 different ranges, every possible price fits into that range. But my table will be comprising of 5 different lines. I can do that, no one can stop me. But why to do unnecessary more work? Keep in mind one thing, the outcome of a call option, whether you are talking from the viewpoint of holder or writer, outcome of a call option where the option will be exercised only when it is in the money. In case of call options, it will be exercised only when market price is greater. So you may combine the two other outcomes wherever you find market price less than or market price equal to the exercise price. Both of those lines can be combined because outcome will be same. If you want, you can write it differently. In 5 lines, outcome will be same. You write in 3 lines, outcome will be same. So in examination and in reality also, why should we write unnecessary things? We should write everything in detail, but we should not write unwanted things. So when I am preparing the payoff table for you, I don't want you to rush copying that table. I'll give you time to note it down. But what I want you to primarily do is, when I am explaining, just focus on the understanding part of it. So let us look into how to prepare the payoff table over here. So in your solution, you first write the investor holds call option for E1 equals to rupees 60 by incurring premium expenses of rupees 9. The investor writes the call option for E2 equals to rupees 70 by earning premium income of rupees 4. So look at one thing, at rupees 60, the investor is holding the call option, and at E2, which is 70, the investor is writing a call option. Now logically, why is this call option having a premium of rupees 9 and this one having premium of rupees 4? If you try to understand that logic, see, simple thing. You have a right to buy because call option conveys the right to buy. So you have a right to buy at 60, you have a right to buy at 70. I'm not talking about combination over here. I'm generally comparing the two exercise prices. E1 gives you right to buy at 60, E2 gives you right to buy at 70. If you have to buy, who would be willing to buy at 70 when there is also an option available to buy at 60? So everyone will be inclined to buy at 60, correct? So option of buying at 60 is more lucrative and therefore will be more demanded, and that is why it has a high price. In other words, it has high premium. So E1 will always be more expensive in terms of buying the option. So E1 is the price for the share, right? that is the underlying. So even the cheaper the price for the underlying, the more and more expensive will be the option, correct? Because if you want to buy cheaper, that option will be expensive. And therefore, over here, our strategy over here is what? You have become a holder at E1 and a writer at E2. Means you have paid premium of 9 and received premium of 4. So the net premium amount will still be an expense, and that will be an expense of how much? It will be an expense of rupees 5. So net premium expense will be rupees 5. Exercise price E1 is 60 and E2 is 70. Now before we make up the payoff table, these basic information you must note down. Alright friends, once you have completed writing these basic information, let us move ahead and now talk about the payoff table. In the payoff table, please carefully look at how we are designing. And once again, let me tell you, the basic payoff table preparation we have learned with the option basics part itself, right? Here we are just trying to combine various options for making rightful effective strategy. So let us proceed ahead with our solution. First, you look into the market price. As we have observed, the range of market price could be classified into 5 ranges, which we have tried to curtail down to only 3. Why only 3? I'll explain to you. See, market price less than or equal to 60. We could have made this as 2 different lines. There is market price less than 60 and market price equal to 60. Because the outcome will be same in both cases, we have tried to combine the 2. Then in the third range, I'm talking third range as in one was below 60, one was equal to 60. The third range we are putting in the next line, that will be market price greater than 60 but it is less than or equal to 70. So again, it is market price which is greater than 60 but less than 70, or it could be equal to 70. So anything above 60 but up to the range of 70 comes in this particular range. Now the last range that we are left over with, market price greater than 70. Now look at one thing, E1 and E2. While you are deciding about the action, don't even bother about whether you are holder or writer. Whoever is holder or writer, it will be either exercised or lapsed depending upon what is the position of the market price. Now first of all, understand one thing. When is a call option exercisable? That you have to always look into. A call option is exercisable only when the market price is greater than the exercise price. Here market price is less than 60, so it is also going to be less than 70 obviously. That means the market price is lower than both of these exercise prices. So particularly if you talk about E1, at E1 definitely the option would lapse. What happens when it is this market price range? So market price is greater than 60 and E1 is 60. So market price greater than 60, definitely E1 will be exercised. Here E1 will be exercised but E2 will not be. Anyway, we will talk about E2 little later. First, focusing on E1 only, because market price is greater than 60, at E1 the option will be exercised, and when market price is greater than 70, obviously it is even greater than E1, so the option will still be exercised. So you know one thing, in the action column there could be only 2 possible actions, either lapse or exercise. What happens when the market price is less than or equal to 60? What happens at action at E2? Definitely the option would lapse. Why? Because a call option is exercised only when the market price is found to be greater than E2. Here market price is even less than E1, so no chance of exercising at E2, so it gets lapsed. What happens in this price range? You see that market price is still less than or equal to 70. In either case, 70 being E2, either case it will be lapsed. It will not be exercised because it is either at the money if it is 70 or out of the money when it is below 70, so the option will lapse. However, when market price is greater than 70, means market price is greater than E2, being a call option, it definitely is found to be in the money, and at this stage definitely it will be exercised. Now till here you are not even concerned with whether you are a holder or a writer, correct? What you just need to now do is, while computing gross payoff, you should be very, very alert that are you a holder or are you a writer. That is important. So when you compute the gross payoff, for the first line, both the options E1 and E2, both options are getting lapsed, and when an option is not exercised, its gross payoff is always 0. Without any calculation, without any thinking further, you can just note down as 0. Now, what happens at the second range when the market price is greater than 60 but less than or equal to 70? E1 option is getting exercised but E2 is getting lapsed. So whatever be the payoff for E1, that will be the payoff for the entire strategy. So what will be the payoff for E1? Because market price is greater than E1, MP minus EP, that is market price minus exercise price, will be the gross payoff. So MP minus E1 or MP minus 60 becomes the gross payoff. Consider one thing, that this is the payoff only and only for E1, and at E1 we are holder, correct? So we are holder, so we are going to receive this payoff. What will happen when market price is greater than 70? Both the options are getting exercised. Now, when both the options are getting exercised, what will be the outcome? You know, you are having the right to buy the share at 60. So you exercise that option, buy it at 60. Counterparty has the right to buy it at 70 from you. So counterparty will exercise their option and buy the share from you at 70, means you will be under obligation to sell it at 70. So somebody telling me that, boss, I have a right to buy at 60 and an obligation to sell it at 70. I buy at 60, sell at 70, I make a net differential of rupees 10. That net differential over here is the difference between 60 and 70, that is 70 minus 60, but I am calling that as net differential because it is 70 minus 60, but it is still your gross payoff. To arrive at your net payoff, you have to subtract your premium expenses, you know it very well. So moving ahead in your table, technically this will be rupees 10. Now how do we get that rupees 10? I am going to show a separate working note for that, and you will note it down little later. First, you have understood logically how it is 10, mathematically how it is 10, I will show it by workings. Now what about premium expenses net? We have already written in the earlier part in the table, I mean before the table, premium expense on a net basis is 555 in either case. Net payoff will be simply gross payoff minus premium expenses. So net payoff will be minus 5 for the first line. It will be MP minus 60 minus 5. So it is MP minus 65. And when it is this part, the net payoff will be plus 5. So now look at one thing. This net payoff is clearly indicating that there is a limit to your loss and there is a limit to your profit as well. The limit of your loss is 5 rupees, the limit of your profit is 5 rupees. So from minus 5 to plus 5, that is your playground. You will never go below minus 5, you will never go above plus 5. That is why these are safe strategies. No matter what happens in the market, for every option, the maximum money at risk is what? 5 rupees. And for every option, the maximum potential of earning is also rupees 5. It will be a final outcome that will range between minus 5 to plus 5 only. That is why these are low risky strategies. Now one last thing that is to be highlighted is the break-even point. Break-even point happens when the net payoff is 0. So in the first line and third line, the net payoff is a constant value, which is definitely not 0. So break-even point here and here it is not applicable. But break-even point will arise in this range. So just understand one thing, net payoff is MP minus 65 and break-even arises when net payoff is 0. So MP minus 65 should be 0. If MP minus 65 should be 0, that means MP should be equal to 65. So MP equal to 65, that is your break-even point. Now your payoff table over here is completed. So just carefully take note of this payoff table, and then I'll show you the working note for how to get this rupees 10. Alright friends, once you have completed writing this whole thing, now before I take you further, let me explain to you one thing. if you observe what is happening, when the market price is going below 60, that is even below E1, what is happening to your net payoff? It is getting negative, right? Means you are incurring a loss. On the other side, when the market price is going up beyond 70, you are making profit. Now what does this signify? What does this signify? You have created a spread using call options and you are making profit when the price is moving up. Which is this strategy? Looking at this table, looking at the payoff positions, anyone can say this is clearly a bull spread created using call options. So if I have to name this strategy, I will call it bull call spread, or you may also call it as bull spread with calls. The right name will be bull call spread. So few things I have to show you. One is the payoff graph and this one working of how we got that rupees 10 over there. In fact, that I have explained to you logically, but in examination, how would you present the answer for that calculation? Let me show that as well. So let us first write up that working itself. So you may write the heading as working note for gross payoff when market price is greater than 70. Now you know one thing, that call option is exercised when market price is greater than exercise price, and the value of call when exercised, it is market price minus exercise price. So when the market price is greater than 70 and we find that both the call options have been exercised, what will be the payoff for E1? At E1, the payoff will be MP minus 60 and this will be an inflow. Why an inflow? Because for E1, the investor is the call option holder. On the other side, for E2, the payoff will be MP minus EP, correct? That is MP minus 70 in that case. And this MP minus 70 is not going to be your inflow. In fact, this will be your outflow, because here the investor is the writer of the call option. So consider one thing, this is your inflow, this is your outflow. So your overall gross payoff will be MP minus 60 as a positive value, and then this MP minus 70, because it is an outflow, outside the bracket I have put a negative sign indicating that this is a negative cash flow, indicating an outflow eventually. When we open the brackets, what do we get? MP minus 60 as it is, this negative sign applied to MP minus MP, and minus of minus 70 becomes plus 70. So finally we have MP minus 60 minus MP plus 70. In this side of the equation, minus MP and plus MP will get offset and will get eliminated, and then what we have is positive 70 and negative 60. So 70 minus 60, which will give you rupees 10 eventually. So please write up this working and then I take you ahead. Alright friends, once you have completed this entire thing, let us move ahead, and now we move to the payoff graph for this particular strategy that we are calling as bull call spread or bull spread with calls. So in your graph on x-axis you will be taking the market price, on the y-axis you will be taking the net payoff. I'm sure you do recollect from the option basics that we are using these breakers over here, particularly on the x-axis, and I'm sure you also know the reason why we should use these breakers. So let me explain to you once again. 60, 65 and 70 is what we have marked on x-axis. Why did we mark 60, 65 and 70? 60 and 70 has been marked because these two are the exercise prices, E1 and E2. 65 has been marked because this was the break even. On the y-axis we will plot positive 5 and negative 5. Now observe one thing. See, the gap between 60 and 70 is the gap of 10 rupees. By that logic, gap between 0 and 60 should be gap of 60, and gap of 60 should be 6 times the gap between 60 and 70. which is not there by measurement. So we are overriding the unitary measurement. That is why we have used this breaker over here. That is why using breaker is important. However, the most important part in this graph will be below the market price being 60, you are going to incur a loss, static loss of 5 rupees up to this price. Thereafter, what will happen? The market price, as and when moving up, your payoff starts getting to the positive. When it comes to 65, it will touch this x-axis. That means you will be attaining the break even, and then with every rupee of price increasing in the market, the payoff goes on increasing, and finally when it reaches over here, the payoff becomes flat, that is positive 5. So this will be your payoff graph for bull call spread as a solution to question number 62. So please take note of this, and then I take you ahead.